This is the Crowdcrux Crowdfunding Podcast with Sal Briggman, where we cover everything you need to know to launch a successful crowdfunding campaign. We speak with proven entrepreneurs who've raised money from the crowd and want to teach you how to do the same. Stay tuned because we're about to reveal how to launch your dream project with your host, Sal Briggman.
Before we get started with this podcast episode, I want to take a second to introduce you to my friends at Fulfillrite. If you need help shipping out your Kickstarter or Indiegogo perks or rewards, Fulfillrite is the absolute best company for you. I've been working with them for a while and I can vouch for their services. They make it dead simple and take all of the headache out of shipping out all of those boxes, all of those orders to your backers and your customers. If you want to check them out, go to fulfillrite.com at fulfillrite.com. What up, crowdfunders? Salvador Briggman here. Welcome back to the Crowdfunding Demystified podcast. On this show, we dissect and get into how to raise money via crowdfunding. How do you actually do a crowdfunding campaign? How do you raise money from the crowd? What are the ways that work? And also the types of ways that you can raise money. So like, for example, you can use obviously crowdfunding for a nonprofit. You can use crowdfunding for a technology gadget or a gizmo or a startup if you're an entrepreneur. One of the cool ways recently that's becoming much more popular is doing an equity crowdfunding campaign. An equity crowdfunding campaign is basically when you are offering shares of your company via an online crowdfunding portal or via a campaign on one of these different portals. So instead of with Kickstarter, basically these are donors on Kickstarter. The people that support your project via an equity crowdfunding campaign are actually investors in your company. And this could be used for real estate. This could be used for more of an entrepreneurial venture. You can use these regulations in so many different ways. So what I wanted to do today is I brought on an expert in equity crowdfunding, an expert in these different regulations, and he also is a lawyer in the space. So he's going to walk you through some of the things that you need to know if you want to raise money under one of these regulations, things that you should be aware of, and also the potential there behind these different raises. We're going to get some more insights into how these regulations differ, some of the major websites that are out there, some of the strategies that you should be aware of in order to get a crowd of people actually interested in what it is that you're doing. A ton of great information if you are at all interested in equity crowdfunding. And also, this individual, I actually drew a lot from his work when putting together my book, Equity Crowdfunding Explained, which I published this past year and is available on Amazon and Audible. Equity Crowdfunding Explained goes step by step through how to do an equity crowdfunding campaign, major sites that are out there and resources that you might not be aware of, how to do the whole marketing component, etc., the different regulations you should be aware of. So this is kind of more, I would say, like nitty gritty, getting really into the facts behind this new exploding segment. So if you are interested in learning more about equity crowdfunding, aside from this podcast here today, that book, Equity Crowdfunding Explained, you can go to crowdcrux.com/equity. That is crowdcrux.com/equity. That will take you to the Amazon page. If you're interested in the Audible version, it's just crowdcrux.com/equity audio. And finally, if you want to enroll in my free course, walking you through some of the major components here, sort of the high level broad strokes when it comes to equity crowdfunding, you can go to the link crowdcrux.com/equity course. That is crowdcrux.com/equity course. So a lot of great resources here if you do want to get started. But without further ado, let's get into today's podcast episode and discover some of the ins and outs of equity crowdfunding. Mark, welcome to the show.
Thank you very much, Sal. Nice to be here. Now, I just want to say at the outset, I do have a cold today, so I just want your listeners to know that I am actually much smarter than I am going to sound during this podcast.
That's understandable. I mean, it's winter season here in New York City. It was snowing like 2 days ago, so I imagine you're going to have a lot of colds going around. Hopefully I don't get one, but I hope you get better, man.
Thank you.
So I kind of want to start off here. Maybe you could just introduce yourself to the listeners, talk a tiny bit about what you do, how you help people, and how long you've been in this industry.
Okay, sure. Let's see. So just a brief background. I mean, I always introduce myself as a boring corporate lawyer. And I've been a boring corporate lawyer for a long time, and in my corporate law practice, the space that I've always practiced in has been entrepreneurs. All kinds of entrepreneurs, all different businesses, lots of real estate entrepreneurs, but lots of, non-real estate entrepreneurs, high tech, non-high tech, that kind of stuff. Just doing all the stuff that entrepreneurs do. And one of the things that entrepreneurs are always doing is trying to raise capital, right? So I always say that, like, if you ever come across particularly a real estate guy who is not trying to raise capital, you better call 911 because he's probably not breathing.
Yeah.
Everyone needs capital. That's why we call it capitalism, because that capital is the lifeblood of our economic system. So in my representing entrepreneurs, I've spent an enormous amount of time helping them raise money under all of the what we can now call old-fashioned rules. And I know how difficult that is, from firsthand experience many, many times over. And that's why, that's by way of introduction to saying that's why when I saw the new crowdfunding rules on the horizon, I realized how important and disruptive, transformative, and wonderful those new rules could be for the entrepreneurs in our society and our whole capitalist system.
Totally.
And so I decided that that's where I wanted to spend my time, because I figured that was going to be a super exciting, challenging, interesting space. And so since then, since about 2012, that's all I've been doing. I do crowdfunding, equity crowdfunding, 127% of my time.
Well, you've also been doing a little bit more, honestly, because I do think there are a lot of lawyers in this industry that could help with something like a Reg D raise or regulation crowdfunding or getting into all the specifics. But you also write a blog. You also educate about this.
I do. I do write a blog, and in this process, I've really learned, the saying that if you love what you do, you never have to work another day in your life. I'm not going to say I love what I do, 12 hours a day, but I really believe in it, Sal. I truly believe in equity crowdfunding from all kinds of perspectives. And that has led me to want to educate the world, because the more people know about it, the more successful it will be, and the better off everyone will be, except maybe Wall Street bankers. But yeah, so I write this blog. I try to educate. I come on shows like yours that are fantastic and reach a bunch of people to kind of educate, spread the news. There are, of course, all kinds of myths, half-truths that I want to correct.
Yeah, I'd love to get into some of that too in the podcast. And just to give the listeners an idea, so I'm looking through some of the blog posts you've written. You have things like tokenization, the legal take on the Jobs Act, equity crowdfunding, and security tokens offerings. You have blog posts on crowdfunding from a legal perspective. What's an investment advisor in crowdfunding? So a lot of these nitty-gritty questions you might have if you're interested in equity crowdfunding. You can check them out at Crowdfund Attorney. I think you're doing a pretty good job, honestly, of covering a lot of these questions. And even preparing for my book, I was also referencing your blog a lot and getting into that. So I kind of want to ask you here. So there are a few different regulations. Like there's Regulation D, Regulation A+, Regulation Crowdfunding. Typically, what are you helping people with most? Is it a Regulation A offering? Is it a Reg D? Usually, where are you helping people?
Well, because I spend so much time in this space, my practice, I think, is pretty reflective of the industry as a whole. In the industry of the whole, of the three flavors of crowdfunding that you just mentioned, Title II, Title III, and Title IV, by volume, Title II is far and away the highest volume type of crowdfunding. And so, in my practice, Title II is by far the highest volume practice. That is Rule 506C or Reg D. We can call it, lots of different words. And then followed by Regulation A, which is Title IV. And then followed way behind, the smallest puppy in the brood or something, trailing way behind, is little Title III crowdfunding. Way back then, you can almost miss it, but I do represent a number of Title III portals, so I'm definitely involved in that space. But it is, as it has always been, even before the Jobs Act. I mean, private investing swamps public investing, right? All the deals that are invested in just through private institutions.
Mm-hmm. Definitely. And when it comes to Regulation D, so like the whole new thing is 506C, which allows you to advertise the offering. Is that right? If you're doing a private offering to accredited investors.
That is 100% correct. That was the big step. So our country's securities laws were all enacted in the 1930s following the Great Depression by Franklin Roosevelt as president and a guy named Sam Rayburn, a Texan Democrat, as Speaker of the House. They enacted all of our securities laws. And one of the fundamental themes of our securities laws for the last 85 years was that public means public and private means private. So if you had a public offering, like a big Facebook IPO, you could advertise that. But if you were just some guy or gal with an idea trying to raise, $1 million, I don't know if you read recently the story, Jeff Bezos, fascinating story about him raising his first $1 million.
No, I didn't read that actually.
Just fascinating because it will ring true with every entrepreneur, how hard it was. He had to beg, cajole to get that first $1 million together. And he had to do it just from people he knew or people they knew, knocking on doors, because private meant private. You could not advertise. Okay. And that's been true for 85 years. That's what the Jobs Act changed by saying for the first time, you can now advertise private deals. And the effect on that, okay, as I always say, fortunately, there are lots of technical legal rules because then people have to hire me. But crowdfunding, including Rule 506C, is just the internet. That's all it is. That's what you have to keep in mind. It's just the internet coming to the capital formation industry. And the internet, any industry it comes into, whether retail with Amazon or Match.com or Expedia or anything else, what it does is directly connects buyers and sellers and gets rid of all the middlemen. So whereas Jeff Bezos, raising his first $1 million, could only go to people he knew, you, one of your listeners who wants to start a business this afternoon, can go online and potentially contact every single investor in the world. That's the difference.
That's freaking powerful, man. Yeah.
It is powerful. It is absolutely powerful.
Yeah, I think that's incredible too, because you're allowed to get your idea out there to so many more people. I imagine though there are some regulations regarding the advertisement. There's this whole thing I think the SEC loves to have different terminology. So for example, advertising is just kind of called general solicitation, and then the way you go about that, I think it's called a tombstone style advertisement. Could you talk a little bit about that? Like when you're doing these ads for a Reg D 506C offering, what can you say in those?
Absolutely. That is a great question. In fact, I plan to do a whole series of blog posts on this very question.
You'll beat me to it.
Well, you can do it first, or we can collaborate.
Yeah.
But anyway, so there's a lot of confusion around the advertising issue. And the answer is that it depends on what kind of crowdfunding we're doing, whether we're doing Title II, Title III, or Title IV. I said a few minutes ago that one of the foundational rules in our securities laws has been public means public, private means private. Another foundational rule.
I had to interrupt this podcast episode because I want to introduce you to my friends at The Gadget Flow. Their product discovery platform reaches 22 million people per month. They've helped more than 5,000 crowdfunding campaigns thus far, and they have a social media following of more than 700,000 followers. If you want to gain access to their marketplace and list your own product, you can go to thegadgetflow.com/submit and list your project today.
Has been that rich people can protect themselves. Rich people can hire expensive lawyers and accountants and advisors. Non-rich people cannot afford to do that and therefore need the paternal arm of the government around their shoulders. And whenever I say that, I sound as if I'm being sarcastic, but that system has actually worked pretty well. You know, this country has the most transparent and vibrant capital markets in the world. Mm-hmm. But as a result of that foundational principle, when you're doing advertising under Rule 506C, bearing in mind that only accredited investors can participate in Rule 506C, accredited shorthand for wealthy. Under 506C, when I'm doing panels sometimes with other lawyers, I will ask them a question. What kind of advertising are you not allowed to use in Rule 506C? And everyone gets a puzzled look on their face. And it's a trick question because the answer is none.
Really?
Because the answer is none. There you go. Because you are dealing with accredited investors, aka wealthy people, there is no limit to what you can say or how you can say it. Of course, you can't lie. You know, you can't say, well, this real estate investment is guaranteed by the federal government, or we guarantee you'll earn 20% per year. You can't lie. You can't commit fraud, but you can, beyond that, do absolutely anything. You can take out radio ads, TV ads. You can pull a banner behind an airplane down at the Jersey Shore during the July 4th holiday. Any kind of advertising is permitted, provided that it's just not fraudulent. And that is because of this foundational principle that rich people can take care of themselves. Now, switch over to the Title II or the Title III and the Title IV worlds. Now we're dealing with non-accredited investors. And so that foundational principle, the same one, says all those non-accredited investors who are allowed to participate need the arm of the government around their shoulder. So we then do have restrictions. I'll just talk briefly about Title IV, which is Regulation A first. In Regulation A, as you know, you have to file a big, thick prospectus with the SEC, filled with all kinds of information. The general rule on advertising a Regulation A deal is, one, you can't say anything you didn't say in the prospectus, okay? You can't just start making up new stuff. And second, anything you say positive about the deal has to be balanced by, negative. There are risks. We're not sure we'll achieve a 14% IRR.
Yeah.
So that's Title IV. Title III is a whole new animal, and there, as your question suggested, there are very significant restrictions. And the one you're referring to says that if you're advertising a Title III deal and you mention any of the terms of the deal, like how much money you're trying to raise or how much the securities cost, then that advertisement has to be limited to a so-called tombstone, where you're basically just saying name of the company, address, website, and pointing people back to the funding portal where the Title III deal is actually listed. So in Title III, the advertising, like so many other things about Title III, it is very much a government, trying to protect all those widows and orphans from people like you and me.
Totally. So I kind of want to get a sense here of like how much you see people on average raising money under these different regulations, just to give the listeners an idea of, what the potential could be. So like under, for example, we were talking a Regulation D raise. How much are entrepreneurs in your experience raising money for, and are they, a company that already has 50 employees? Like, how much are they already doing revenue? Is it pre-revenue? These are just some common questions I want to get answered here, and give them an idea of under each rule how much you're seeing most people raise for their round.
Well, okay. So in Rule 506C, Title II crowdfunding, 90% of crowdfunding, at least Title II and actually Title IV, 90% is real estate still. And those deals, a good real estate deal these days can easily, raise a few $1 million. Yeah, I would even say $3 to $5 million. Then I guess I need to just a blockchain is a special case. There were 6 months or so where a blockchain company could raise $200 million in a week.
Yeah.
Those days have passed, but you're certainly talking about a Rule 506C offering. People are raising several $1 million. They're not raising $25 million. They're not raising $50 million, but they're raising a few $1 million.
And 90% real estate, you said there.
90% real estate, I would say. I mean, that's an unofficial calculation on
ballpark.
Ballpark, but I bet it's pretty good ballpark. Title IV, as you know, you're allowed to raise up to $50 million, and the biggest names, the people like Fundrise, have raised, sequentially a number of funds, each raising the full $50 million. It's $50 million per year. I think we think of a successful Regulation A offering as raising $10 to $20 million. Mm-hmm. It's certainly possible. And then Title III, as you know, you're limited to raising $1,070,000 per year. And those are just all over the board.
Lots of different types of companies. Raising lots of, some companies raise $10,000, which seems to me crazy because their cost of doing it was probably $25,000, but there you go. When it comes to the startups there, like with the 506C or the Regulation A plus offerings, what are you seeing there? Like, I know you mentioned real estate as being a really strong component for the entrepreneurs in the audience. Like, can you give us an idea of the types of companies? Like, are these companies that have been around for like 10 years already? Or are they startups? Are they pre-revenue? Can you shed some light on that?
Sure. If you're talking about real estate, and I'll talk about both, then the successful companies are those that have been in business for a while, have done 10 deals under their belt or something, and are sort of, now going to a broader public. So it's not really a question of how many employees they have, but if they've raised $50 million of capital successfully, or even $20 million, then they can probably raise money successfully using crowdfunding. It's possible in real estate, you got a good project, you can raise a few $1 million for your first deal. I mean, that's kind of the beauty of real estate, in that there's kind of an inherent value that investors can see. Other companies, let's put aside the 90% that's real estate, the 10% that is non-real estate. Here it becomes a question of how many Facebook friends do you have? And by that, I mean, crowdfunding kind of is the intersection of social media with capital formation. And so the most successful companies are those with some kind of inherently sexy story. And one, just as an example, breweries, alcohol manufacturers have been phenomenally successful raising money through crowdfunding. Surprise, surprise. But other companies that make a cool consumer product, that are great for the environment, that have some story, and particularly companies where the group of people that are potential investors and the group of people who are potential consumers of the product and service are identical. If you can be doing a crowdfunding raise that is simultaneously, in effect, an advertisement for your product or service, that kind of company tends to be successful.
I'm speaking to the crowdfunders in the audience who have already launched a Kickstarter campaign, or have actually even successfully run a campaign. And the reason is, I think you will understand this pain point most. And that is, when you finally do raise money on Kickstarter or Indiegogo, the hardest part is not collecting the cash. The hardest part is shipping out all of those perks and rewards to your backers. It is a nightmare, my friends. It's a lot of spreadsheets, it's a lot of headache, and it's a lot of stress. That's why I recommend BackerKit. If you have not heard of BackerKit, they help you collect surveys, they help you collect data, and the entire fulfillment process is just so much easier and so many less spreadsheets when you use their software. You can check them out at backerkit.com and use CrowdCrux for a special discount. Interesting. So it's almost like with crowdfunding, the people that are supporting it, number one, are investors, but they're also the buyers, the consumers of that product, or they believe in that kind of to a certain degree. I've also seen software companies be really successful, I think, with equity crowdfunding. Actually not so successful on Kickstarter and Indiegogo, which is kind of interesting. So I kind of wanted to ask you a question here when it comes to Title III. So let's just do a jump right here and talk a little bit about Title III, because when it comes to this whole new regulation, this whole new way of raising funds, I think it's kind of confusing, but I've heard a lot of different things in terms of the amount that you're raising. So if you're raising less than $107,000, that the actual financial and tax burden of doing that is not terribly difficult. What are your thoughts on that?
Yeah, I've heard that too. In fact, a new client told me he had been told that yesterday, and it's just not true. There's a lot of there's a lot of misinformation around Title III, unfortunately. And I guess it's not surprising because it's such a kind of mom and pop space. So the 107,000 number is relevant to only one thing, and that is whether you have to have your financial statements reviewed by an accountant. This guy told me yesterday that he had been told by one of the leading platforms that if he raised less than 107,000, he did not need a lawyer, but if he raised more than 107, he needed a lawyer. People also will sometimes say, well, if I raise more than 107, I need an audited financial statement, and if I raise less, I don't. That is completely untrue. You never need an audited statement in Title III crowdfunding. So So the way it works, the way the rules work, the only thing that changes as the amount of money that you're raising increases is the level of review of your financial statements. That's it. And unfortunately, I think in the Title III world, people have allowed that tail to start wagging the dog. And so you will see on some of the major platforms, without naming names, you will see companies having a target amount of as little as $10,000. And they do this, they're told by the platform, well, if you only raise $10,000, then you can start spending money as soon as you reach that threshold, and you don't have to have reviewed financial statements. And that is definitely letting the tail wag the dog for both the issuer and the platform. I wrote a blog post about this recently, and I feel pretty strongly about this. As you know, this concept of, well, how much money is a company going to raise? This goes way back pre-crowdfunding. And the answer is that the company should be raising the money that it needs to execute its business plan. It may not, be raising enough money in this round to take it to profitability. Maybe in this round it just needs to raise enough money to get 3 patents, or it needs to raise enough money to hire a CMO or something like that. But there has to be some business-driven threshold. How much money do we need? Instead, in the Title III platforms, we're getting these purely arbitrary numbers and very low numbers. Well, just say you're only raising $20,000, because then you'll achieve success. I'm afraid, and I'm quite sure this is happening, that sophisticated investors are basically saying, to heck with that,
Yeah.
So, I'm not investing in a company. This company maybe needs $600,000 to have a viable business. You think I'm going to be the first 10,000, and I'm just going to watch my money go down the drain? So I'm afraid that what's happening in the Title III ecosystem is that these platforms are driving away serious investors. And that, it's maybe a short-term benefit for them because, let's say the company raises $10,000, then great. Then the platform gets its fee on the first $10,000. But at a cost, a huge long-term cost of just, if I'm a serious investor, I don't look at those platforms.
Understandable.
For that very reason. So anyway, that was a long answer to a short question.
Your perspective then, I guess, just to clarify, is that no matter how much money you're raising, that there should be contact with legal assistance and an accountant for looking at your financials, or your perspective is that it doesn't need it no matter how much you're raising?
It depends. Which is a horrible answer.
It's a lot of gray area,
I hate to say, you have to get a lawyer involved, because it sounds so self-serving. And I know these companies are scraping by. The last thing they want is a big legal bill. And so I told the guy yesterday, the new client, no, you don't need a lawyer. If you feel comfortable with filling in the templates and so forth, do it yourself. Now I say that with a little reservation, because these are,
you don't want to mess it up. Yeah.
You don't want to mess it up. There's certainly no threshold, whether 107 or 307, where here you should use a lawyer, here you shouldn't use one. I will say that we as an industry, myself included, we have to do a much better job creating templates that companies can fill in so they don't need lawyers. And I'm including myself in that. And when I represent the funding portals, and I represent a number of them, I try to create very simple templates that issuers can complete for that reason. But am I 100% successful? Absolutely not. So there is this fuzziness in the space for sure.
I think that's 100% true. Needing more standardized templates, but also having an understanding of all of these different terms. Because for a newbie entering the industry to hear these words like issuer or general solicitation or all of these kind of vocabulary words, it can seem a little bit intimidating. I think there's almost like there's own language when it comes to legalese or finance,
yes.
And people that are in those areas are very familiar with it. But a new person, a salesperson or entrepreneur that goes into that, they really don't understand. So it's very difficult. Sometimes you almost lean on the platform for the advice and the information because you don't know any better.
Yes, and I think that is how it should work. It's just that the platforms and their lawyers need to do a much better job. Listen, this is brand new, and it is, a change from 85 years of practice where you wanted to raise money, had to have a securities lawyer. And so what the internet does is it breaks down those barriers, and it demands, that we stop using that sort of legalistic lingo, that we simplify, that we standardize. That's what the internet does, and it is doing. But we're in, Title III crowdfunding is only a few years old, and we, as an industry, we have a ways to go to make it really useful and successful.
So I just have a few more questions for you here. Number one being, you mentioned a lot of these different platforms that you work with. Do you have like a handful of websites that people can go that are listening to this show, just to like a bullet point, like sites they can go to learn more about different platforms that are out there? Like I know big ones are, Start Engine, WeFunder. Can you list off a few more that people could check out?
Boy, now you're going to put me on the spot, because now I'm going to forget to list some of my own clients, and they're going to be really pissed off at me. So if we're talking about, Title III platforms, here are a couple platforms that I would check out. They do happen to be my clients. I think they're done fantastically. One, it's the only Title III platform that is actually devoted to real estate, and it's called Small Change. Spelled just the way it sounds. And it was developed by a woman, a good friend of mine, a real estate developer, and it's around making money from real estate with real estates that change communities for the better. And I just think it is kind of the epitome of what a Title III site can and should be. So cool.
I'll check that one out.
And I guess there's another one. I'll just mention one more, and that is one called Honeycomb Credit. And they do sort of small business, almost microloans, like $50,000 to $100,000 loans. And I think they do an excellent job of trying to simplify for both issuers and investors.
Awesome. Cool. Thank you. I appreciate that. So the last kind of question that I had for you here was, I think we're also seeing a big difference when it comes to like new like very cutting edge ways of raising money. So like tokenization as a good example, starting with ICOs and now like STOs. Is that something that you're involved with? Because that's a really cutting edge kind of area, I think.
Well, yes, I am very heavily involved in it. I do STOs, I do ICOs. But it's not, it is, what do I want to say? It's a very useful technology. It is, when I say it, blockchain, very useful technology. It's a better way of keeping track of things. But in terms of capital formation, it's not that important. That is to say, if you think, and I'm going to also make a lot of people angry with me here, but blockchain, if you can think of it as a really the next iteration of spreadsheets, so to speak. Now, spreadsheets were an enormous improvement over what came before them, and it increased productivity and all those things. And so when I say they're like the next iteration, blockchain is the next iteration of spreadsheets, I don't mean to be, denigrating them at all. But they're a way of keeping track of things, just as spreadsheets were. And how you keep track of something doesn't fundamentally contribute to its value. So, there have been a few real estate offerings that have been done on the blockchain, and they've got very successful. It was a great marketing idea to do it that way. Does the fact that, your LLC interest is kept track of on the blockchain, does that make your underlying real estate, the underlying apartment building more valuable? Not much. So blockchain is an important development. And I certainly think that in the future, all securities will be kept track of using blockchain technology. So it's a super important development. It just doesn't have a lot to do with, the value of the underlying investment. That's the only thing I would say.
The only thing that I took away just from seeing some of this technology kind of permeate these new industries is it adds also a certain degree of liquidity. If you are trying to have like a secondary market in the traditional sense, it's a little bit more difficult, particularly with equity crowdfunding. But it seems like doing something like an STO, it might be a way that you can actually trade those kinds of tokens in your own community there. Kind of adds a bit of liquidity that might not have been there previously.
Well, a little. I mean, just a little. So I've written blog posts on this topic as well. So, I mean, you have been allowed legally to have like secondary markets for private securities for 85 years. There basically aren't any such markets, or there are just a few. And when you start to explore why there aren't any, yeah, a little bit technology, but it's mainly because, who wants to buy a used limited partnership interest where there's no publicly available information and everything's secret. And that is as true in the when things are on the blockchain as when they were just pieces of paper, stock certificates. So yes, it has the potential to increase transparency and security and communication, and all those things are important, and they will add to the liquidity. But the underlying impediment to liquidity in a secondary market is information. And there's nothing about blockchain inherently that will provide investors with additional information. So yes, it's good. It's just not,
Yeah, I understand.
It's just not earth-shattering, I guess I would say.
Awesome, man. Well, I think we could talk for hours, honestly, about this. And I would love to have you back at some point. Maybe we could talk more specifically about one of these areas. I encourage listeners, reach out to me if you have any questions, and maybe we can construct like another podcast episode. This is the first time that we talk, so I really kind of want to just get your thoughts on a few different things. But I really appreciate you for coming on, and I kind of want to give you the last word here. There's a lot of great stuff also on Mark's website. Going through, you have a crowdfunding cheat sheet, you have Regulation A resources, legal links, etc. So I urge you guys to go and check out Crowdfund Attorney. But my final question for you here is, if you could leave a message with those that are listening to this show, entrepreneurs in the audience that are thinking about raising money, what is it that you would say? It could be a word of encouragement. It could be a final bit of advice or a tip. It could be a word of warning or caution, anything like that. Would love to leave you to have the last word here.
Well, for people trying to raise money, I definitely think it would be encouragement. We are in a whole new world now, and as I said near the beginning, this afternoon, if you would like to, you can have a website that theoretically reaches every investor on the planet, not this in this country, but every investor around the world, and that is a enormously different universe than I grew up in. So that is a super cool and positive development. The flip side of that, not the flip side, but there are a lot of websites out there, and a lot of them have very, shall we say, entertaining material. And so when you are advertising, you are competing with all those websites. So I'm going to say something that I've probably said 10,000 times since 2012. Crowdfunding is a marketing business. Okay. It's not a technology business. It's not a legal business. It's a marketing business. How to structure an offering that will be attractive to investors. That's what, if you're trying to raise money, that's what you should be thinking about from the very beginning. And, good marketing is not, well, let's just build a widget and then try to sell it. The question is, well, what kind of widgets do people want to buy? Let's build that kind of widget so that the marketing is built in from the very inception. It's all about marketing, and that is where, as an entrepreneur, in my advice, as all my clients know, is stop thinking about the legal stuff, stop thinking about the technology stuff, just think about marketing stuff. And finally, crowdfunding is successful, of course, for entrepreneurs because it gives them access to every investor in the world. But it's very important for you as the entrepreneur and for me as a crowdfunding lawyer to look through the other end of the telescope as well. Crowdfunding is successful because it gives investors the opportunity to see every deal in the world. Make your deal good for investors, okay? And then everyone wins. So that's another long-winded answer.
Very well said, my friend. Thank you so much for coming on the show, sharing all of your knowledge and information. I appreciate your time, and we will have to have you back.
Thanks very much, Sal.
Let me tell you about our latest sponsor, SendPro Online by Pitney Bowes. Shipping can be complex. Things can get really confusing really fast. With SendPro Online, it's easy to save time and money no matter what you send, from letters and packages to overnights and flats. You can easily compare USPS, UPS, and FedEx in an all-in-one online tool. You can print shipping labels and stamps directly from your printer. You can even track all of your shipments and get email notifications when they've arrived. SendPro Online is only $14.99 a month, and listeners can get a free 30-day trial when you visit pb.com/crowdcrux. That's pb.com/crowdcrux. Experience the convenience of SendPro Online for yourself when you sign up for a free 30-day trial. Thank you for listening to this episode of the Crowdfunding Demystified Podcast. Again, my name is Salvador Briggman. Thank you for joining me here, spending a little bit of time learning about equity crowdfunding, learning about these different regulations and how you can raise money from the crowd, doing your own offering online, and actually getting investors in your business. I learned a lot from today's podcast episode. I also hope you took away some good teachings and some learnings and maybe some resources in terms of where you can go next. If you are interested in enrolling in that free equity crowdfunding course, the link for that is crowdcrux.com/equity course. That is crowdcrux.com/equity course. And in addition, if you'd just like to go right ahead and sort of dive in and get all the knowledge and information that I have on this subject, the things that I've been researching, the things I've been learning, you can go to the link crowdcrux.com/equity. That will take you to the Amazon book that I wrote. And also, if you want to do crowdcrux.com/equity audio, that would take you to the Audible version of that book. So my goal here, number one, is to warm you up to how to do one of these projects, get a sense of like what components you need, the costs behind it, the regulations, the things you should be aware of going into a project. But in addition, I kind of want to also like get into how these different platforms differ, because I don't think there is like a Kickstarter for equity. There isn't one major player. The way that the platforms are broken down actually is kind of more so by regulation and what they're good at in terms of those different regulations for raising money. So it's a little different of an industry, and I'm really wanted to get this book out there to kind of explain all of that to you. So I hope you enjoy it. I hope you also like today's episode. Go and check out some of the other episodes on this podcast and give me a review on iTunes if you did like this show. I appreciate it so much, and I will see you next time.